Now you see the housing market slowing down because you see higher rates are having an effect. That should have an effect on housing prices, perhaps even fairly quickly, so that prices won't necessarily come down, but price increases will flatten out. We're seeing lower home sales, we're seeing lower starts, so we're seeing a slowing in housing.
This is Bloomberg Markets. I'm Kriti Gupta with John Ehrlichman. You were just listening to Fed Chair Jay Powell testifying earlier today before the Senate Banking Committee. And the U.S. isn't the only country seeing signs of a housing slowdown. At least that's the topic of today's Big Take. Joining us now to break it all down is Yelena Shulyatyeva, senior U.S. economist for Bloomberg Economics. Yelena, thank you as always for joining us. This is a conversation we've had in the markets for some time now being priced in. You also had a Bloomberg scoop, I should add, that hundreds are being cut or reassigned in J.P. Morgan's mortgage unit as housing demand begins slumping during this rate surge. So you can really see the effects across really all parts of both the market and the economy. But I have to ask, the faster the deceleration that you're seeing, what are the ripple effects that you're going to see across the U.S. economy in particular?
Well, I think the U.S. economy is pretty much insulated from a full-blown housing crisis akin to what we saw back in 2007. I think it's just the thing is that real estate, if you look at that, homeowners' equity in real estate is at the highest level since 1980s. You look at debt service ratios, they're at the lowest levels. So the households have delevered quite a lot. So the risks to the financial system from the housing market are pretty low at this point. Of course, housing will slow down and it will have some spillover effects on consumption and so on. But that's the whole idea of slowing demand by raising interest rates, as Chair Powell mentioned today.
Yelena, interesting to hear you say that, echoing some of what we just heard from Megan Green of Harvard as we look at some of these bubbliest housing markets around the world based on the economics work that Bloomberg has done, whether it's New Zealand or Australia or here in Canada, where over the last couple of years it has not been surprising in some home markets to see prices increase by more than 50%. You know, there was a trend that started going back to the financial crisis where more conservative Canadians who managed on the economic front and then saw record low interest rates for basically a decade started to get in. So could we be in a situation where the U.S. navigates relatively well, but has to be keeping an eye on these global housing markets because of this uncertainty?
Absolutely. I think, yes, you're right. Canada is among those countries that potentially see the highest risks, according to the analysis that was performed by my colleague Niraj Shah at Bloomberg Economics. I think the U.S. is relatively safe in this environment. And again, because I think the U.S. consumer has delivered quite a bit relative to what we saw back in the early 2000s. So I think that is a really important distinction here. Also, the U.S. consumer has accumulated a lot of savings, and those excess savings will provide some cushion despite the fact that the savings rate in the U.S. has fallen quite a bit since the peak we saw back during the crisis.
Yelena, about 30 seconds here. I have to ask simply about whether or not we actually see a housing shortage continue, because it's not just about crimping demand, it's on the supply side as well. How long does the housing shortage last?
I think the supply being short will support housing prices to a certain extent this year, because there's a lot of housing in the pipeline, but those houses cannot be finished simply because they're lacking doors, windows, sinks, whatever, because of supply shortages. So we will not see a significant improvement on the supply side, which should probably prevent housing prices from going down this year at least.